the 4 best index funds slash ETFs to invest in. Now, before I reveal those 4, I do want to touch on the difference between index funds and ETFs because there are some differences. How you can do the research to make sure that you invest in the correct fund. I'm going to reveal the 4 index or ETFs funds, of course. And then if you are planning on investing globally, what you need to pay attention to. And also the future of these funds. Where do I see these funds go? Are they going to get more popular? Are they going to get less popular? So let's just jump into it. An index fund or an ETF is nothing more than a collection of securities that mirror a specific investment portfolio. So for example, if you take the S&P 500, which is an index of the 500 biggest companies in the US, those companies within that investment have their own weight. So let's say company A is represented by 30%, company B might only be 5%. If you invest in an index fund that mirrors the S&P 500, your money will also be distributed based on that weight. The first index fund was created by John C. Bogle. He passed away in 2019, but he was the founder of the Vanguard group. You can still invest in that index fund that he created, and it's still widely popular. It's an index fund that tracks the S&P 500. Now, the first ETF in the US also happens to track the S&P 500, and it's also widely popular. It's called the SPDR or also the SPY. The S&P 500 is a popular index to use as a benchmark. Many money managers and fund managers use that as a benchmark and comparing it to their own investments that they're managing. They're looking at how the S&P 500 is performing and they're trying to outperform the S&P 500. In the short term, they're more than likely able to outperform the S&P 500. The question is, can they do that over the long term? A major benefit that you have when you invest in an index fund or an ETF is that it eases you into the investing world without you having that much knowledge or experience when it comes to investing. Even myself, the first index fund that I purchased was the VFINX, which was the Vanguard S&P 500 index fund. Now that index fund taught me a lot because it taught me how my fund was performing. So emotionally, how do I feel when I see my money go up, but also when I see the value of my investment portfolio go down. It also taught me about, okay, these are the 500 companies that I'm invested in and what's the specific weight by company. And one thing that I noticed that tech companies had more weight in that specific portfolio, the S&P 500. Another thing that I noticed was that every quarter I was getting paid a dividend, which is something that was new to me back when I first started investing in index funds and ETFs. So I was able to track my dividends and see, oh, my dividends gets reinvested back into the fund. So not only am I getting my capital gains, which is my investment increasing in value, I'm also getting that dividend that gets reinvested into that specific fund. Another thing that I also appreciate when investing in an index fund is that I'm immediately diversified. So in this case of the S&P 500, I'm investing in 500 companies. So I don't have to go out there and do the research on which companies I need to add into my portfolio. I don't have to cherry pick every single company. Just investing in the index fund, I'm immediately diversified, and also I don't have to manage and maintain those companies. Because if a company isn't performing well according to the standards of the S&P 500, those get kicked out and then new companies are introduced into that S&P 500. And if you invest in an index fund, since the index fund mirrors that index, you will also have those new companies in your portfolio. Index funds versus ETFs. What's the difference between the two? What should you be paying attention to? Which one should you focus on? Now, when I first started investing, I focused on the index funds, but I actually like ETFs better. And there's 3 reasons why I like the ETFs better. The first one has to do with the fees associated with index funds and ETFs. If you take a bunch of index funds and you compare them to their equivalent ETFs, you'll notice that the fees on the ETFs are slightly lower than the fees of the index funds. Especially if you take a mutual fund and you compare the fees or the expense ratio with the equivalent ETF, you'll be blown away and shocked how much you're actually paying in fees for the mutual fund. And like I always say, any money that you can save in fees is money that you can invest in order to build and grow your wealth. The second reason is that you can trade with ETFs just like how you can buy and sell stocks. So you can buy and sell whenever you want throughout the trading day. This is not something that you can do with an index fund, because with an index fund or even a mutual fund, you can only trade at the end of the trading day. But with an ETF, you can trade in the morning, midday, even before the market closes. That's a big benefit. And the third reason for choosing an ETF over an index fund is because with an ETF, you can participate in options trading. Now, this is not something, of course, that you can do with an index fund, but a lot of investors like ETFs because of the options component attached to the ETF. With the ETF, more than likely cheaper than the index fund. When I invested in my index fund, I had to put $3,000 down just to get into that S&P 500 index fund. With the ETF, I can buy a single ETF of that same equivalent, which is currently around $300, and start trading. So the first one is the VOO, which stands for the Vanguard 500 Index Fund ETF. Now this is the ETF, of course. If you want the index fund equivalent, you want to take a look at the VFINX or the VFIAX. Now the VOO is one of my personal favorites. It's also the first ETF that I started investing in. And with the VOO, you're just trying to match the market. You're not trying to beat the market, because the VOO, the S&P 500, you're just mirroring the companies that are in the S&P 500, which is being used as the benchmark, of course. Now the second one is the BND. This is the Total Bond Market Index Fund ETF. Now the cool thing about this one is that if you look at the top securities in this fund, they are all treasury notes, and the treasury note has a maturity date of between 2 and 10 years. All those treasury notes have different maturity dates, and they have different interest payment dates. So with a normal treasury note, you get paid once every 6 months, but in the bond ETF, you get paid on a monthly basis. And even if a bond matures, you don't have to go out and buy new bonds, because you can just be invested in BND, hold on to it, and you'll be getting interest payments on a monthly basis. The third one, I call it V2, but you actually spell it VTWO, which is the Vanguard Russell 2000 Index Fund ETF. Now the cool thing about this ETF is that it mirrors the Russell 2000. The Russell 2000 being 2,000 small cap companies. The good thing about these small cap companies is that they have the potential to blow up and become mid cap or large cap companies. Also, small cap companies don't have that many eyeballs as the mid and large cap companies. So there are a lot of hidden gems available in that Russell 2000. And number 4 is the VXUS, which is the Vanguard Total International Stock Index Fund, ETF. Now, if you're the type of investor that wants to invest globally or even internationally outside of the US, you more than likely know that investing internationally, a whole new set of risks come into play that you normally don't have to think about. Economical risks, companies paying out dividends but not as consistently as companies within the US. There's a lot of risk associated with investing in companies in countries that you might not be familiar with. That's where this ETF plays a big role in your investment portfolio. And I have an interesting story about international investing. I like to invest in individual companies, but I also like to invest in index funds and ETFs. And I was looking at investing in some of the companies in a different country. I was looking at investing in companies internationally. So I was looking at different countries, and I was looking at different continents, and I was using a stock screener in order to plug in my numbers to see which companies I can add to my watch list and then eventually buy. So I was looking in Brazil, I was looking in Africa, I was looking at China, India, and I found a handful of good companies to invest in. One of them was in China, which was China Mobile. So I went ahead and I think I paid about $300 to $400 to buy stock in China Mobile. So I was collecting the dividends on a frequent basis, and I was watching the value go up and down like it always does in the stock market. But a couple of months after I bought it, the government actually banned China Mobile. So they did give you a heads up of a couple of months before the ban, But I'm the type of investor, I don't always look in my investments account on a daily basis, especially my international investments accounts. So what ended up happening was when I actually logged into my account, I noticed that the ticker symbol for China Mobile was turned into numbers. So I tried to sell it after I knew what happened, and I couldn't sell it for a couple of months. And that's where an international stock ETF fund would be perfect because a fund manager is always up on the latest information. So in this case, the fund manager would take the necessary actions in order to sell China Mobile, which of course I didn't know because I wasn't paying attention to all my international stocks. I was focusing on my watch list of the stocks within the US. And another one that you can add to the list is called FIO, which invests in mid-cap companies. So we've hit the large cap companies with the FIOO. We've hit the small cap companies with the FI2, which invests in the Russell 2000 companies. We've also hit the bond market, which is the fixed income asset, with the BND ETF. But if you also want to round it up, large cap, small cap, and then mid cap, make sure you take a look at FIO. Now, you might be thinking, okay, Giovanni, I like this list, but why are all these ETFs and index funds Vanguard specific ones? Well, you can look at the equivalent ETFs and index funds from different companies such as Fidelity, but you will more than likely notice that Vanguard has the lowest expense ratio when it comes to their ETFs and index funds. Now, how do you do the research to make sure that you're investing in the correct index fund or ETF that has a proven track record of success? There are two things that I pay attention to: the management team and the performance. So let's talk about the management team first. Whenever you're investing, even in a mutual fund, index fund, ETF, you always want to pay attention to the track record of the management team. How long have they been managing the fund? How long have they been in the business? The investing world is extremely competitive, so if you don't perform, you're out of there. So if you can find a fund, an index fund or an ETF that has a track record of success with the management team, more than likely that's a good one to stick with. For example, I'm gonna pick on one, the VFIAX, the Vanguard 500 Index Admiral. You can go to Morningstar, type in that ticker symbol, you will get some results. What you want to do is go to the people section. The people section will show you the management team. I already did the research and I noticed that Donald and Michelle are both on the management team managing this specific index fund. They've both been managing this index fund for over 5 years. Not only that, you can also get information of how long they've been in the business and also their educational history, which also helps. So picking on these two fund managers, Donald has been managing different funds since 1997 and Michelle has been managing different funds since 2017. And then of course the second thing is performance. Now you can still do this, you can still research performance on Morningstar, but you can also go to, for example, Yahoo Finance. Just stick with the free stuff, don't pay for this stuff. Sticking with Morningstar, just scroll over to the performance tab and you'll see a graph with a benchmark, more than likely the S&P 500, and then the index fund, mutual fund, or ETF that you chose, and you can compare the two. You can see how your index fund performed compared to that S&P 500 benchmark. Pretty much what you're looking for is your index fund, your ETF, your mutual fund needs to beat that benchmark. Now, where do I see the popularity of ETFs and index funds going into the future? Well, I think they're gonna get even more popular. Maybe not with the younger crowd, because the younger crowd, they wanna be a lot more risky when it comes to investing in individual stocks, investing in crypto. They wanna make their money fast. They wanna become a millionaire fast. But more of the older crowd, 30 plus, 30 and up, they are more than likely gonna focus more on ETFs and index funds compared to, for example, the mutual funds and investing in individual stocks. Be sure to like, subscribe, and leave a comment, and let me know which of these ETFs or index funds is your favorite.